You're very good at recognizing bubbles, and I think obviously gold is close to our heart, and I think so. So from a physical gold perspective, obviously we don't sell. I mean, and nobody I know that we handle physical for has sold a single ounce in all of this. But when it comes to trading gold, I understand you recognized quite quickly that gold was being chased by the momentums who control pretty much 80% of oil, gold, silver, in the derivative markets. And I think you recognize that that was a bit of a bubble and they were driving it beyond fair value. You got out, didn't you?
Well, we like to say we didn't sell the bullion, but we sold and all the gold miners we had, we sold half the miners. Okay. We sold all the silver miners and most of the silver. What was happening was if you get to a point where it's in the news every day and every retail investor is going down to the nearest coin shop and buying silver and gold, you're probably close to at least a short-term high. And we felt like that's where we were. They've all sort of gone into hibernation right now, but I think they'll come out again. I mean, I think this thing will pick up steam again. It's not abnormal for these companies, I'm talking about these miners, to have a setback in here. However, if they were to sell, Andy, at the same cash flow levels they sold out in 2011, they'll go up another 200% from here. You have to look at on a relative basis where they are, because they make a lot of money. Their debt situation's much better than it's ever been. And I think you'll start to see some merger acquisition as well.
That's really interesting. Yeah. And again, because there's a big difference between paper gold and physical gold. And yeah, so I think that's something that we teach a lot of people. If you want to go and play in the high volatile stakes, derivative markets, be aware you're in the crosshairs because you're going to be a small guy. In fact, I've spoke to, I know one of financial analysts. He said, you know what? He said, of the people, specifically trading silver, he said, of the people that trade silver, he said, probably 100, one out of 100 ever makes any money because they get picked off. And the thing is, because it's, I mean, look at what we've been looking at. Whereas it used to be, maybe 15, 20, 30 cent moves in a day, $10 moves in a day. I mean, you're talking major losses or gains, if you're on the right side of it, that is. Which you've got to be a big boy to be on the right side of that.
Andy, like I say, I've been around longer than most people. So I watched gold in the late 70s go from very low price up around January of 80. January of 1980 was about 850, and that was the high. But here's the big thing. I watched Bunker Hunt buy enough silver. He really loaded up on silver at $20, and I watched it go all the way to where he was the richest man in the world, owning that much silver. And I can't remember the number. I wish I could, but it was something like 6, 7, 8 billion at the time, which was a lot of money then. And even doubled up and bought more when it was higher, and watched it ride all the way back. I mean, you're thinking, okay, here's a guy that knew when to buy it at the low. I mean, I'm seriously, he was, at the time, he had to be the richest man in the world by that time from buying that much silver. But that's one of the things now gold I can see owning forever, but silver, I think you have to trade it. And it comes and goes. It's a little bit more industrial. And it'll go again. I really believe that. I think it will go again, but I think you ought to think about it and trade it if you can.
I think what's interesting also, we're very, very close to the Chinese, the SGE markets, the free trade zone there. We've got liquidity providers there. And it's interesting to see that in order to trade gold or silver on that exchange, you need to first own it before you can put it up for sale. And you need to, so what's happening is I've noticed that a lot of refiners, producers, and institutional guys are saying, you know what, I want to avoid all I want is a physical price. And there is, in our view, there's now sufficient liquidity, physical liquidity in the free trade zone exchanges to actually bring in that kind of open interest, so to speak. And so if you've got a physical price for silver, for example, in particular, you've got a physical price, and it generally trades at a premium to, of course, to derivative silver because it's physically settled and you have to own it. So what's interesting is that slowly over time, and I think this may have influenced Bank of America's high target of 309, obviously 135 or 309 out of range, but is the ratio compression. Because if you've got more of a physical settlement going on all the time, it kind of starts to dissolve what we call the synthetic ratio, which is really paper, and silver. So it's interesting. I'm just thinking, watching that's quite an interesting dynamic.
Well, both silver and gold, and really all the metals, they changed the way they traded, not only that way, but in the futures market, everything has changed a lot. And it's interesting, I'm talking about this thing on Bunker Hunt. And one of the things that made that price go down is the commodity exchanges changed the leverage numbers. They did 2 or 3 things because it was getting too crazy. This thing went nuts. I mean, it went so high. And as soon as they did that changed the game, So you have to watch out for those things, because if they change something on you, it can affect the price and you're not ready for it because you're not thinking about it. I'll give you a real good example. The S&P 500, the Standard & Poor's, is now going to let companies that do not make any money come into the S&P 500. They've never done that before. You had to have at least 4, that's why Tesla was never in it for a long time. You have to have at least 4 quarters of profitability. Well, think about it. They're going to dump all the venture capital and private equity firms and that stuff. And so people not thinking are going to buy the S&P 500 and not realizing I'm not getting all profitable. That's going to change that game. So you have to watch for those outside influences, what you're talking about, because they'll change on you. And if you don't know what you're doing, you'll go as business as usual, which is not.
We're kind of focused very much on precious metals, the real assets and all the stuff but really, what's so important to follow the crosses, everything that interacts with that, and that makes where you make your decisions on so many of these inputs and how they all correlate together. And that's a tough job. So, and I know, can we start with the psychology of staying rich? And it seemed to kind of echo what you're currently calling or prioritizing, which is, I think, very much about capital preservation versus chasing highs, etc. So could you tell us, there's a lot to unpick, Ted. Can we start maybe there and see what do you see?
Well, Andy, we buy single stocks and single bonds, but what we look at is really the valuations of a lot of things in the marketplace. And I have to tell you, most of them are very expensive, too expensive for us to buy. Not everything. I mean, we own things, but I think what's happening is that people have gotten so caught up in just buying the averages, buying the S&P, they forgot about valuation. And I know I think in general, after this last 15 years, it's sort of a situation where they can't go wrong. In other words, it don't last very long, so they just dive back in. And we're really at the highest point ever, at least in the U.S. for households that own stocks. They own more stocks now than they've ever since we've been keeping records. So I know they're all in, and actually on a worldwide basis, they're all in too, because if you look at the MSCI and all those sorts of things, the U.S. is about 63% of it. So it's very expensive, and I think you just have to be very particular about what you own.
Yeah, and I think what amazed me through it all is there's the stock market making higher and higher highs through this entire war fog that we've seen, all this volatility, and yet we're seeing, as you say, every dip getting bought. And as you say, is it retail that's buying these dips, or who is it?
Well, it's a lot of retail. We've had more retail in the market today than we've ever had in the marketplace, and they're used to buying these things and come off a little bit and they go back to a new high. And they're really not really thinking, Andy, about the macro look or anything. I don't think they really realize what again, anything about valuation. So they just buy it. And we're seeing that all the way around, really. A lot of speculation, just a tremendous amount of speculation. And so it's not surprising that they think nothing can go wrong. But eventually, I've been in this situation before. I remember I've been around a long time, probably longer than most people, but 1996 to 2000, by the time we got to 98, I thought, gosh, this thing's expensive. Well, it got more expensive. And we were sort of a fish out of water by the time we got to the end of 99. However, it really paid off for us because we did well the next 3 years when everybody else was just really getting smashed. But I think you have to hold to your principles, and I don't think a lot of investors today have any principles. I think they just buy it and they don't even really think about it.
Well, I guess if you're in the game and your colleagues and your competitors are buying the dip and you don't, and you're wrong, you probably get fired. But what gets me is, as you say, you've been around a long time, and I look back and I see also a lot of these guys that I speak to on the desks, they haven't been around very long, and they haven't seen any of that. What you're just talking about, they haven't seen any of that. They just figure, you just keep buying it, it's fine. Just keep buying it because look, it works every time, and as long as they've been in it, it's worked.
Well, statistically, and I've got a pretty good statistic on this, about 46 or 47% of people in the industry today have only been around since 2009 or 10. And that just tells you that they've never been through any really particularly true bear markets. Bear markets last longer. They really take you apart. And so they've never seen that. And